Joining us right now to talk about that and much more is Carol Schleif. She is Chief Investment Officer of BMO Family Office. And Carol, before we get to earnings or any of the rest of this, I have to ask you about what you think of Fitch downgrading the U.S. credit rating. Is that appropriate? What does it mean? What would you advise investors?
I think the interesting thing, as you've already alluded to, is the timing of it, but it's not necessarily unprecedented. They're stating a lot of things that all of us know about the erosion in governance flexibility or fluidity, if you will, and amounting debt, and also the interest rate that the U.S. government is going to have to pay on that debt. But I think it's indicative more broadly, especially when you look at the jump out of equities this morning, at least futures-wise, into some of the fixed income safety trades. That part's not unexpected either, as we take a little money off the table or people look to lock in some of the gains they've seen. Just from that, let's pull back on some of the risk stance we've taken.
So you don't think the decline in the futures this morning is related to the downgrade as much as it's just we've come a long way? We have seen some big advances in the equities market, and maybe it's time to take a little risk off the table?
I think when you start layering in, you've got some weakening data, you've got some indications in the labor market that's softening as well. We're not seeing massive layoffs yet, but you are seeing some softening. You're seeing that willingness to quit a job and start a new one is lessening a little bit. So you start taking those things all in order. And we've been in the camp of expecting a soft landing for well over a year. And now that a lot of the rest of the market has come to that position, there are a lot of risks, potential risks, especially if the Fed looks at things, looks at how optimistic people are staying, and decides to either keep rates higher for longer or feels like it has some wiggle room there because they don't want optimism to keep driving things too aggressively and force them to keep raising rates.
So you've been long the markets to this point, but now you're a little more neutral?
Well, I think we've been a balanced risk exposure all the way along in terms of wanting to play some of the growth trends, but also wanting to participate as the rally broadens out into mid and small cap. But that balanced exposure means that we've never just thrown all the way in on the let's go aggressive towards the growth, but just cognizant of the fact that there are still a lot of potential tail risks out there, and the tail risks are always the ones that bite the hardest.
So I'm sorry, I'm just trying to parse through it. You've been surprised by the strength of the equity markets to this point?
A bit surprised at how strong they came up off the bottom, but it was legit in terms of looking at the economic progress we've made so far. And if you look at last year's markets, really presuming that there was going to be a recession around the corner, and then that recession not emerging, some of that snapback was positive, was legitimate, if you will. But our overall asset allocation hasn't really changed much. We've focused on the United States as where we want it to be. We've been in the mid and small cap as slight overweights relative to large cap all along. And so hoping and really benefiting from this broadening out that we've seen, but also stating that we don't want to get too optimistic, lean too far into that growth mode. It might be an opportune time, if you're overweight some of those big tech names that have gotten even more overweighted, to trim some and cycle back into the broader markets.